Good morning, ladies and gentlemen. As always, we start with the fixed income market in the States, where very little happened despite non-farm payrolls on Friday. As we told you last week, the market was likely to remain within a 10 basis points consolidation. This is the yield chart of the 5-year note, and in fact, it stayed within less than 10 basis points. We have this trend line from the lows, which it cannot break in any way. We have the 200-day moving average, which is still pointing towards higher yields, but we have the daily Bollinger Bands contracting, and I fail to see any reason why next week we should not remain in the same range as we have remained for the past week. There is really very little on the horizon that is going to make us move from these levels. If we look at the 10-year and the 30-year, we have very much the same sort of pattern. The 200-day is still moving higher, indicating that we are likely to test levels slightly above around the 233 to 235 level in yields, and those will be then very critical levels from which we will have to make either a very swift move down or up, but that is really left for the month of September. And for the Fed, nothing is going to happen in the next 1 or 2 weeks which will decide that pattern. The one that is beginning to be more and more bullish in our eyes is actually the TLT, which is 20s to 30s. The moving average is, we think, beginning to turn. This action by the market above the moving averages is long enough in duration that it is going to turn it very soon, and we will have the possibility for higher prices in TLT, and that would be lower yields. But we think that we can leave that for next week and the week after. There is absolutely no reason to jump in and be long of TLT here. Prices will not be that far different in 5 to 10 days time, when we will have much more data and information upon which to base a real decision. The European markets are doing exactly what we told you they would do. This is a chart of the weekly 2-year note, the Schatz. It is right at the middle of the weekly Bollinger Bands. It is unlikely, in our opinion, to do very much more on the downside, i.e. in terms of lower yields. If we compare that to the 5-year note, that has more room to reach the middle of the Bollinger Bands. It's now trading at -23. It could get to -30, so that's another 7 basis points on the downside. And even more pronounced is the Bund, the 10-year, which is now trading at -47 and could come down all the way to -38. So a position short of Schatz and long of Bobble and Bund could pay off in the next couple of weeks, but it's going to be very marginal. We're only talking about 2 or 3 basis points of flattening of the curve, i.e. Less negative. It is not it's basically a throwaway trade, something that you are trying to make 2 or 3 basis points out of, as opposed to riding it for the longer term. But certainly we see very little pressure on European rates, even if the Euro USD were now to reverse slightly. It is going to have a very marginal effect on these spreads. the lethargy of the fixed income markets and the differentials between Europe and the United States is actually quite well reflected in our view for Euro US dollar over the course of the next week. We have had a slight purge of longs at stupid levels. We are likely to continue seeing that purge, but only about to levels consistent with a normal retracement, which would be around the 115.15 area. We could easily be making an ABC, which we do not expect to violate this level between the 0.382 retracement and the point 0.5, i.e. 116 to 115 something. So in the 115s, it is likely that the market will stabilize and try and push higher again. These moving averages are now in full trend. It is going to be a very difficult time to come down and break them at the first attempt. The market is overbought, as indicated by all the technical RSIs and stochastics, but we think the retracement is going to be quite shallow for now. The DX closed below 96.63 again, very close to it, but did close below it. To us, that is just a sign of extreme weakness in the long term, while we now think that certainly we can go and test at some stage over the next week or so this 95.07 level. We think it is going to be very well capped there. That would equate to a 50% retracement of this initial move, which in terms of Euro US dollar is somewhere in the 115s, so it mirrors Euro US dollar. Any first attempt at 95.07 in the dollar index is a short, and then we will see. You can see how many times it has traded in these areas between these very important levels of 93.63, 95.07 and 96.50. It is likely to do very much the same thing and then probably break down again, confirming the final break of 96.63, which will then probably have a bigger wave in place. If we can say that this is the beginning of the first wave, and this is we're somewhere in the middle of a third wave or fourth wave up, then we'll definitely at some stage over the course of the year test this downtrend line, which will be somewhere around the 90 level. So selling around 95 should get you about 5 percentage points down to 90 at some stage during the course of the year. Our commodity indicators show that basically the rally of the past couple of months has been nothing more than a reaction to a lower dollar. There is no inflation in the system. This is just adjusting prices for a lower dollar. We just don't see these patterns as significant or ready to break to the upside at any time in the foreseeable future. We think it is more likely to stay in a range, just reacting to the current price of the dollar index as opposed to doing anything else. The more heavily weighted towards oil have bounced slightly more than the ones more heavily weighted towards metals, industrial metals, but really not a lot to write home about, and that is why we think the 30-year is actually beginning to look attractive, because the inflation indicators are saying that there is absolutely no inflation whatsoever out there. So anything which is yielding you 1.5% over what inflation is going to be for the foreseeable future is probably not such a bad investment. Moving on to equities, just want to show you that, in fact, if you're trading European equities, given the fact that US equities are so stable and have been so stable for the past 2 weeks, you are in fact trading Euro USD. So you might as well trade Euro USD as opposed to European equities. As we told you on Friday, we had this move up, a squeeze in European equities on the back of a lower Euro USD. But still, we are within a very narrow range where we have been for the past several weeks. Don't think that this trend line is now particularly significant. We, given the fact that we just cannot see Euro USD breaking through 115, which is, I don't know, 1.5% lower than the current price, it would be very surprising if the stocks could really break 35.30, 35.40 or 35.50. This kind of area is going to be very tough to break without the S&P making a major move. And as we will see in a moment, that is unlikely to be very quickly. This is an hourly chart of the DAX. We can see how much damage has been done to the DAX over the past several weeks. Naturally, Euro USD is the most culpable here, but also the fact that this is very auto heavy, and the United States seems to be having a very big problem with its auto industry or sales going forward of new cars. It is unlikely that the DAX will be a star performer in the near future, simply because it is facing the two headwinds of Euro USD, which we don't think goes much lower, and also the car industry, which is not going to get much better for the foreseeable future. So can it get to 12,500? Yes. Can it get up towards the 12,550 where all this support was? Certainly. But can we see it really making moves above 12,600? Unlikely for the time being. So maybe positions short of DAX and long of stocks will be warranted once the market gets up to these levels. In the US, we think that the best chance of getting a read on the market in general is going to be provided by the transports. As you can see, last week they bounced nicely off the 200-day moving average, and now it's going to be very interesting to see what they do when they reach the 9,400 to 9,500 area. If we cannot break much higher than that, then the break of the 200-day moving average is almost assured. On the other hand, we have had periods of time where the 200-day moving average has been tested and then new highs have been made, but only marginally. This happened in 2014-15, and after that we had a big swoon. We think we might be getting into the same position again. We would not be surprised to see one more marginal new high out of transports, confirming the new high into the 2500s by the S&P, followed by a swoon in the transports, which will be actually the tell for a sell, a longer term sell in the S&Ps. But transports, certainly we are watching them like a hawk. We did buy some down here on the 200-day moving average for a quick trade. We are doubtful that we will see impulsive new highs. We are hopeful but doubtful, and we are watching it like a hawk, because what it could be doing is one of those head and shoulders over time, which will then break both the 200-day and the trend line, which has held since the lows in January 2016. Don't forget that the transports turn first, and it would be natural that the transports turns down first as well. So we are quite apprehensive about the market in general, longer term speaking, and we're watching the transports to give us a tell. Moving on to the S&Ps, I mean, what can you say about a market which has closed within 1 point of itself for the past 2 weeks, and with ranges which are ridiculously narrow? Well, every time that has happened in the past, periods like this, periods like this, periods like that, we have had eventually a test of the 50-day moving average. All successful tests, but we have at least tested it. The moving average at the moment comes in at 24.41. I'm sure that in a couple of days' time it'll be slightly higher. We would love to see a move down towards the 50-day moving average to buy it for probably new highs in the S&P. That would coincide with our view of the transports. Are we going to get it? And what is going to be the catalyst? Well, it's very tough to tell. We have a potential cascade lower if we were to break the low of this range, and that is what's going to give us the test of the 50-day moving average, which we are sure is going to be successful, at least at the first try, just like it was here, or just like it was here. So we are hopeful that we will get it, and we are hopeful that we know what the trigger is going to be. Well, the trigger could be something like this. I tweeted this on Friday late. Interactive brokers all by themselves decided that they were going to raise quite substantially both margin requirements for all VIX products. They're talking about initial margin and maintenance margin. Initial margin, they will go after the immediately, and maintenance margin after the 19th of August. Well, what is that likely to do? It is likely that a lot of people will have short volatility positions, much more likely than long volatility positions in any case. And also it is likely that other brokers might follow IB's lead over the next few days. Quite why they've decided to do it now? Has it been an intervention from some central bank that has suggested to them politely that maybe it would be a good idea if mum and pop went extremely short of volatility? I don't know naturally, but it should certainly have an effect. What kind of an effect is something completely different, and sometimes actions have unintended consequences. To examine the unintended consequences, let us have a look at a chart of XIV, which is basically the inverse of VXX. I'm using it because it's so much easier to see on this inverse rather than a very flat VXX. Mom and pop are most likely to trade these instruments. They're unlikely to trade VIX futures, or certainly not in any size. These are the instruments that they are most likely to be holding or be short of. If we have a look at this pattern, we certainly have distribution up here. We have had red closes for the best part of 2 weeks here. We certainly don't seem to be having too many buyers. This would suggest that any kind of liquidation would again take us to this 50-day moving average, which is around 85-86 at the moment, which would make sense because those are the previous highs and we have some gaps to fill, and we are outside all of the channels. So a quick move back down into the mid-80s certainly would not be unwarranted for the XIV. and that would equate to a move of around 2 to 3% in the VIX. Naturally, you are free to short XIV or go long VXX, but what we think is a far safer trade is actually looking for a steeper curve in the first few months of the futures curve in volatility. Why? Very simply because of the way these VXX and XIV work. VXX needs to sell the front contract and buy the next contract, and every day over the course of the next week until expiry on Wednesday the 16th of August, you can see this contract expires actually on the 16th, but the last trading day is the 15th. They have to sell over the course of the next 5 trading days the bulk, about 90% of their position, in which is long August. That means that VXX, every time you actually liquidate VXX, what you are doing is telling VXX to sell more and more of the front month and buy more and more of the back months. So the curve will actually steepen in terms of the VIX futures. We think that is a far safer trade than just going outright long of volatility. And here is a chart of August futures in VIX against December futures in VIX. We have been buyers of this spread for several weeks, and we think it goes to the moon, simply because historic volatility is in the S&Ps is so low. Historic volatility is just over 2%. Actual volatility that you pay when you buy options is about just 10%. So the front contract has to come down another 130 points to converge with cash, while we think that any liquidation in VXX is going to have huge consequences for the back months of the VIX futures. So a strategy of selling the front month and buying a spread of back months should be very profitable over the course of the next 8 days. Very similar to the trade we did last month, where we sold the front month and we bought the next one. Well, I this time wouldn't buy just the next one. I would buy a spread of September's, October's, November's and December's, again short August. Any spike, short-term spike in volatility caused by a movement down to the 50-day moving average in ES or VXX or XIV is going to be brief and short-lived. It might take a couple of days for the market to get back to normal, but we think at the end of the day what will have happened is that the curve in VIX will have steepened, simply because there will be less players short the back months. The back months is where we think people will liquidate their positions as opposed to the front month, simply because of the way that VXX works and the pressure it induces on the curve. In terms of what's going on with our spreads, and as you know we follow something like 50 different spreads, well, very little apart from these two. This is the Dow against the S&Ps, and as you can see we've had a very rapid move which has broken this consolidation trade which has lasted since the beginning of the year. The Dow is far outperforming the S&Ps. This has happened every time that people have felt defensive. It happened back in 2008, it happened back in 2000, it even happened in 1987. So obviously this kind of inverse head and shoulders with this moving average, 200-day moving average, moving up and the market bouncing off it, is an indicator that any time the Dow performance falls down towards the 50 to 200-day moving average, it is likely that the Dow will be better bought against the S&Ps. It's an aggressive defensive strategy, and we think that the market is therefore uneasy about what is happening, uneasy about the valuations, but it does not want to liquidate its long positions for fear of missing out on the upside, which actually gives you more fuel to the downside when it really starts. And the other chart, which is very interesting, is SPY, so the S&Ps against IWM, which is the Russell 2000. We are beginning to turn the moving averages, indicating the potential for a move up to where we were in January of 2016. This is a bearish long-term development, we would argue. People are supposed to be in or prefer the Russell 2000 to S&Ps at the moment, and yet the opposite is happening. We are seeing definite signs of risk off, the first signs of risk off via the spreads between S&Ps, Dow Jones and Russell. So when you take it all together, what are people doing? People are selling Russell 2000 and buying Dow Jones. They're selling weaker quality stocks and buying better quality stocks with more secure earnings. Aggressive defensive. Everything we know about the way spreads trade and the way markets behave, we have condensed in our model, which every day gives us a score between -100 and +100 for what is going on in the spreads in the equities and fixed income. The score on Thursday here was 84. We haven't run it yet, but we doubt there'll be any change today. If it is, it'll be very, very marginal. And the most important thing is where the 50-day to 200-day moving average is. This period of consolidation at a very high level enables the 50 and 200-day moving averages to come together. And that actually is what enables the cross of the 50 to 200-day moving average after a failed upside test to new highs. So we are very, very hopeful that our view that we make new highs at some stage and then fail and then make a lower high and then we can start a correction is actually very much encouraged by this kind of behavior of the moving averages. All of this brings us to the biases, a distillation of what we just told you, 5 and 10-year notes, narrow consolidation, 10 basis points up or down. We don't think they're ready to break either way yet. Bunds and Bobble, we wouldn't short them. We think the Schatz is a much better short at the moment. Short Schatz against small longs in Bunds is probably the way to be. We just don't see any inflation at the moment. All the commodity indices did was react to the weaker dollar, and therefore nothing there. Yes, 3 to 4% consolidation. The danger is to the upside once we've tested the 50-day moving average. From there we could have a 70, 80, 90 point rally quite easily, simply because people are not prepared to give up on this bull market yet. But 25.20, 25.40 is going to be a very, very attractive level to sell for much lower prices. 1383 in Russell 2000, absolute key. We will watch that with great interest. VX, we think the curve will get steeper as a result of liquidation, certainly in VXX. The super cycle, nothing has changed. The US stocks against emerging markets and EU stocks were remarkably stable last week. No change there. No change even when the dollar weakened. Those they closed the week very much where they started the week. It just shows you there are very, very few sellers of outright equities. There are, we think, better buys, and there will be better buys below, certainly in emerging markets and in Europe. The dollar index 93.60, again we close below it, close to it but below it. We think 95.07 on the upside is likely to be all we're going to get, and longer term shorts around that level are going to be probably called for. Thank you very much indeed, and speak to you all on Monday.